The globalists have launched a war against humanity and civilization. Their goal is complete destruction of nations and the creation of a global unitary technological government. In this pursuit, having no democratic authority, they use their obscene fortunes to dominate finance, politics, health, media, and every aspect of our lives. Many people and websites are giving excellent coverage of ongoing events and revelations. Many brave people are speaking out in great personal risk. All these are directed towards the Great Awakening, but awakening is not enough. The globalists don't fear it. No one elsewhere is setting out a roadmap for defeating the globalists before they eat us up. The globalists have a plan. Patriots need a plan. This is the purpose of Nations Over Globalism, to show how patriots can defeat practically the New World Order. We need a new constitution for each nation where the globalists and their corrupt helpers cannot operate. We need a peaceful revolution in every nation. Nothing short of this will do. Nations Over Globalism can be seen as a political party in the making, so it has an all-inclusive program and an all-inclusive analysis. We need to rebuild our nations from top to bottom to banish the globalists. The globalists are parasites, nothing more. Nations Over Globalism covers all bases: constitution, civilization, economics, political philosophy, sovereign nationhood, globalist parasites, politics, history, welfare services, political science. It has to be comprehensive. All will come together to form a unified political program and a theory of government and nations. The patriotic fight to overcome the globalist parasites must occur within each nation, for it is the nation that will defeat them. But nevertheless, it is a global battle because every nation is facing the same onslaught from the globalists and their hired traitors. The democratic machinery is damaged, but not broken. We must contest elections to raise our profile as a political force in pursuit of our goal. The mainstream media can ignore street demonstrations. They cannot ignore parliamentary success. I will expand Nations Over Globalism's internet presence and hold online conferences and webinars. I want to hear your point of view. We need an international movement of separate sovereign nations acting independently. In addition to these recorded videos, I will be doing live broadcasts. So stay in touch by signing up for the Nations Over Globalism newspaper at the website www.nationsoverglobalism.uk. I am Peter Keller, writer, presenter, and creator of Nations Over Globalism, coming to you from Toulouse in southern France. If you are a patriot, I need your support. Part 1. Economic Science and Political Economy. The distinction between economic science and political economy is not part of the orthodox economic mindset. I doubt that graduates in economics will be able to tell you what the difference is. This is because economics pretends it is a pure science, not a social science. It reduces every person to an economic actor with the same goal: accumulation of the maximum amount of money for each one of them. This is sometimes referred to as homo economicus. No one is imbued with any more complex motives, such as excelling in their work or contributing to society, or perhaps being a parasite on society. Up until Adam Smith, the term economics was not in circulation. All matters pertaining to trade and money came under the heading of political economy. However, what I would call economic science was practiced, and there were theories in this subject. Most were completely wrong, but theories pretending to be scientific all the same. Economic science concerns mainly money and how it's created and circulated. This is because money can be quantified and so is treatable with the rigor that a science demands. Political economy is concerned with the behavior of individuals and companies insofar as it affects the economic life of the country or the world. When we discuss the interventions by globalists and parasites in the economy, we are in the realms of political economy. In this video, we are concerned with how money is created and circulated, and so we are dealing with economic science. When people try to pervert the scientific workings of money, they are really operating in the realms of political economy or simply politics. Such people thus intrude on our discussion of economic science. Part 2. Sound central banking. Managing the money supply may seem like an old-fashioned idea. It belongs to the days when men wore ties, not open-neck shirts. Not so long ago perhaps, but definitely in the dimmer recent past. Serious attempts to manage the money supply were thrown to the winds when the idea that the Japanese had invented was adopted in the West. This is known as quantitative easing, or QE. The great innovation of QE was to use central bank accounting to instrumentally address problems in the economy. Traditionally, the central bank, the Bank of England in the case of the UK, had performed what can be described as essentially housekeeping roles, and these were 4 in number. 1. To operate as a clearinghouse for private banks' transactions on a daily basis. 2. To be a lender of last resort if the banking system lacked temporarily liquidity. 3. To create and hold its own central bank reserves, which backed money that was saved in the economy. 4. To regulate and oversee the activities of private banks. Thus, the central bank had no instrumental role in managing the economy. It simply monitored and facilitated money movements. Part 3. Bank liberalisation under Brown. The major move away from this formula happened in 1998 when the new Chancellor under New Labour, Gordon Brown, took away the 4th function of regulation and gave it to the newly created Financial Services Authority, the FSA. But this change was carried out in typical Brown fashion under the well-trumpeted smokescreen whereby the setting of interest rates was no longer the remit of the Chancellor but was passed to the bank. This was proclaimed as a radical departure and a cure to all our ills, as interest rates would no longer be subject to political goals, but would be independently and objectively decided by the politically neutral bank. With this move, Brown claimed to have ended boom and bust, and this phrase was regurgitated by the mainstream commentators right up to the arrival of the next bust in 2008, after which it was quietly forgotten. The idea that the bank set interest rates free of government interference was of course nonsense, and the real change was in the regulation of the private banks being removed from the Bank of England and passed to this new authority, the FSA. The FSA was instructed by Brown to have a lighter touch on regulation than the bank had maintained, and so we entered a new period of even further deregulation of the City of London. The consequences of these changes played themselves out in 2008 when the massive crash happened and the banks and other financial companies found themselves insolvent or nearly so. The essential problem was that assets of every kind, properties, shares, derivatives, were absurdly overvalued, and when they dived, banks' balance sheets no longer made any sense. The banks could have been left to go into liquidation for their greed and mismanagement, but this did not happen. Chancellor Alistair Darling and his government under Brown decided to bail out the banks. That is to say, pour billions of pounds into the banks' balance sheets to restore their solvency. Small and medium-sized businesses and individual property owners devastated by the crash were sent into bankruptcy. Now, the important point of this in our discussion of QE is that the money to bail out the banks came from the government. It was raised by selling bonds, increasing the debt of the government, and so indirectly of every person in the country. The morality of the bailout was not considered. The public sense of trust in government and banks took a hit from which it could not recover. To a reasonable person, attention should have now been drawn to punishing the banks for their unscrupulous conduct and take steps to ensure there could be no repeat of the 2008 crisis. After all, even in practical financial times, it could not work if the government was to be forever having to give money to the banks to make them operable. Part 4. Introduction of QE. But instead of putting balance sheets to right and laying a foundation for future prudence and forthrightness, the government took over the idea that the Japanese had pioneered in the 1990s, the notorious QE. What is this quantitative easing? As I said, traditionally the central bank had no instrumental role in managing the economy. It simply monitored and facilitated money movements. This is sound banking and sound management of the economy. If the economy is not doing well, then it is nothing to do with the central bank and its neutral function. QE reverses all this and uses the central bank as an instrument of economic policy. Until QE, the bank's balance sheet was simply a reflection of government activity. With QE, the bank became a direct participant in the economy. The City of London private banks had shown themselves to be completely without conscience or business propriety, but instead of being corrected for their misdemeanors, the government, through QE, put in place a money-generating machine that could constantly fund the private banks to maintain their stability. QE was obviously so contrary to all good money management principles that it was hailed as just a temporary measure. We now know it has proved anything but temporary and instead has become an essential part of the way the neoliberal economies of the West are run. Part 5. The Road to Economic Hell. Everyone knows this is the road to economic hell, but each successive Chancellor and Governor of the Bank of England has kicked the can down the road, leaving the mess to fall into the laps of later occupants of these positions. The logic of QE was dressed up in some completely fraudulent ideas. It was said that by the central bank buying up government bonds held by the banks would then be sitting on more liquid cash, and they could release this to businesses to enable them to finance investment. This in turn would create growth in the economy and so benefit all. As we know, the reality has been that the extra money the banks have had, they have used to lend on assets, properties, shares and bonds. The stock of these had not increased proportionately, and so the effect has been to increase the price tag on existing assets. You can see this tangibly in the prices of houses in your area, in the low yield on bonds making your pension pot less valuable, in soaring rents, and in an overpriced stock market. So QE for the banks has benefited asset prices and little else. The balance sheets of the Bank of England, the European Central Bank, and the Federal Reserve of the United States were propelled into the stratosphere. But following the purchase of government bonds by the central banks, things then moved into a new gear of insanity. Central banks started to acquire stocks belonging to companies in dire straits, junk stocks. No private investor would buy them, but the effect was to lift the value of these stocks artificially, so providing stimulus and confidence in the economy. The ECB is sitting on millions of virtually valueless stocks, and so is it itself technically bankrupt. Let us be clear, QE is an abomination and it will lead to a horrific downfall at some time. The solution will no doubt lie in engineering a general global crisis to shift the problems of debt into another realm of disaster, so obscuring the truth of what is happening and how we got here. But let us not go there for now and return to the mundane matter of how we should manage money. Creating additional money in the economy should be a necessary part of the management of a healthy economy, but it has to be part of an orderly process, and it has to go with certain other reforms in the way that we run the country's economy. And it has to be backed up by some real understanding of how money works. The theory for it has to be rigorous, the empirical evidence for it strong. Part 6. The quantity theory of money. The economic orthodoxy under which we live has no idea of how money works. It is under the spell of the so-called quantity theory of money, which is centuries old. Like most, yes, most pieces of orthodox theory, it does not work in theory and does not work in practice. This double refutation does nothing to shake the faith of economists and economic journalists in this fairy story. The quantity theory of money tells us that if there is more money in the economy, this will result in more money chasing the same number of goods, leading to a rise in prices, inflation. In fact, the theory is quite correct in respect of one part of the economy, the operation of asset prices, although ironically, the orthodoxy does not apply it there. The problem is that it is applied to only consumer goods and what we buy in the shops. The reason why there is this difference is that for the consumer good economy, the speed of circulation of money is highly flexible. If there is more money around, it will do less work. That is, each unit will be used for fewer transactions, or as the economists say, the velocity of money slows. This has no effect on prices, for these are determined by a whole load of other factors, wages, commodity prices, and above all, competition between suppliers. A stimulated economy can bring more entrants into any sector and so more competition. Also, economies of scale can occur and so prices fall again. There is absolutely no correlation between more money being available and rising prices of shopping basket goods. If anything, the converse holds. Part 7. Asset prices. However, let us come back to asset prices. Asset prices will rise if too much money is created for the needs of the consumer economy. The money has nowhere else to go. The effect of this is to create more inequality between those who own assets and those who do not, making the jump from being one of the latter to one of the former more and more difficult. This has been the deliberate strategy of all governments, starting with Thatcher, and it works for them as they create a hard core of support among the asset owners. So why cannot asset prices be held in check by an adjustment to the philosophy of money, as we saw was the case with consumer prices? The reason is simple and obvious. The big difference between an asset and a consumer good is that once it comes into existence, in general, it does not go away. Yes, properties can be destroyed, shares can be wiped out, but overall, the stock of traditional assets is relatively fixed in comparison with consumer goods, which by their nature are disposable. The stock of assets has a huge inertia. Yes, we can build more houses, we can create more businesses with more share value, but this is a slow process, and so an increase in money manifests itself in an increase in asset prices. You have seen this in practice since the 2008 crash, where massive money creation with quantitative easing has resulted in massive inflation in asset prices, but something close to deflation in consumer prices. This has had the orthodox economists scratching their head as to why their precious theory is not working. How many times have I heard orthodox commentators referring to the dog,
that does not bark. They just cannot understand why the quantitative theory of money is not working. Of course, this does not lead them to admitting it is wrong. They say there must be other factors at work. Part 8. Inflation. The bank QE we have had to date has given extra spending to banks. But what would happen if instead of giving the money to the banks, we gave it to the people? This is called sometimes the people's QE, where extra spending power is given to consumers. The orthodox economists are horrified. They see hyperinflation around the corner. The example of Robert Mugabe's Zimbabwe is cited endlessly, as if the Zimbabwean economy and the British economy are in any sense comparable. As I have shown, the increase in money introduced directly into the consumer economy will not in itself produce consumer inflation. But this does not mean we can supercharge spending by consumers willy-nilly without reference to other factors. Although the velocity of money is subject to huge swings, it is not infinitely variable. If there is too much money in the consumer economy, people will increase their savings. But if there is way too much, then people will become very rich. But what is wrong with that? If people accumulate excessive amounts in their savings, then asset prices will go up because there is nowhere else for the money to go. Note, there is no reason for consumer prices to go up. If anything, they may go down for the following reason. As I remarked, when asset prices go up excessively, as is now happening, society becomes more unequal, and so those without assets will be more vulnerable and will consequently be forced to accept less wages. This is the evil associated with rising asset prices, and as I have shown, rising asset prices result from excess money in the economy. So the people's QE, if excessive, will, like banks' QE, result in excessive asset prices, prices that bear no relation to the operation of the real economy. The difference will be that the owners of those assets may well be more widespread than asset prices resulting from bank QE. That may be considered preferably, but it is not desirable. People's QE would work initially in the way people intended, but it is not a long-run solution. That is not the way to run an economy. In fact, the whole idea of QE in general is wrong. To understand why, we have to look at how government finances work and how the Bank of England works and at the relation between the two. Part 9. The government as private corporation. The government, as we have it, is run essentially like a private corporation. It trades like a private corporation, with income. In the government's case, this is almost all taxation. Now there are no longer profits from state enterprises as there were before Thatcher. And expenditure, public services including the military, subsidies and the running of the government in general. The source of income and the type of expenditure may be unique to the government, but in terms of accounting, there is no difference from a private company. It has a profit and loss account and a balance sheet just like a private company. It generally makes a loss on its trading year to year, which we call government deficit, and so it correspondingly shows a debt on its balance sheet, the so-called national debt. The debt it covers in exactly the same way as a private company would, by borrowing. A private company can borrow in two ways. One, by getting a bank loan, and two, if it is big enough, by issuing bonds, corporate bonds. Likewise, the government can run up an overdraft with its banker, the Bank of England, but the vast majority of its debt is covered by the issuing of bonds. In effect, as regards its finances, we see our government as an independent private corporation. There really is no difference. Sometimes people talk about the government printing money as if it had control of the money, but this is a misunderstanding. The government prints bonds, which are IOUs, which it then has to sell on the private open market. A private company can print bonds, which in exactly the same way it has to sell on the open market. Part 10. Money creation. So in principle, we can say that the government's activities do not affect the money supply, for it does not create money. So who does increase the money supply? Remember, we are talking here about pre-QE. Money reformers like Ellen Brown, or positive money, will tell you that it all comes from one source, the private banks, creating money which they loan out. This view comes with the corollary that if all loans were paid off, there would be no money left in the economy except notes and coins, which are a very small percentage of the whole, and everything will come to a standstill. This view ignores the fact that people have savings, and not all the savings are used for lending. Some savings just sit there. Without going into the technicalities of this, these inactive savings correspond to what are called central bank reserves, which are massive. Effectively, these savings backed by central bank reserves constitute money in the same way as notes and coins do. So if all loans were hypothetically paid off, there would still be a lot of money around, keeping the economy moving to an extent. In a successful economy, people accumulate savings, and so the money supply grows regardless of how much banks are lending. Now here is the rub. If there is an oversupply of money in the economy, as I have said, this goes into asset price increases, and savings are assets. So quite simply, the excess money ends up in people's bank accounts. They may just keep it as money sitting there, and in a properly run economy, that would not be bad for them, as interest rates would be at a reasonable level. Or they might buy government bonds. They won't do that directly, but by putting money into a pension fund, the pension operator will do it for them, and that is where most pension money is placed. Now, with the invention of QE back in the 1990s, a third form of money creation arrived. In this case, the central bank simply adds money to its balance sheet and spends it. Here it is legitimate to talk of printing money, which, as we saw, the government never does. The government is run as a private company, and private companies do not print money. The Bank of England has always printed money in a sense, as it has to respond to private bank lending and to increases in savings. Both of these have to be represented on the central bank's balance sheets. What is different about QE is that the bank is not creating money due to a demand in the economy, but creating it out of its own initiative. Well, we can argue about whether it decided to do the QE itself or by instruction from the government. The reality we know is that the bank is not and has never been independent. The government of the day takes the decisions. The QE money until now has only been used, at least in Britain, to buy government bonds held by private banks. This keeps the central bank's balance sheets tidy, for it has an asset, the bonds, to balance the money created. It means that the bank collects the interest paid out annually by the issuer of the bond, in this case the government, and so we have the rather absurd spectacle of the government passing money to the Bank of England. However, it is strongly rumoured that these interest payments are not always truly made, and so if this is the case, the bank has created the money to finance government expenditure, a situation that horrifies the orthodox economists and indeed any economist. Part 11. Government debt. So what should be done? The essential problem is that we are viewing all money creation as happening through the central bank while leaving the government to be run as a private corporation, having to account for itself exactly as if it were one, and being punished for running up debt. Now, this may come as a surprise, but there is nothing wrong with the government running up debt in principle. And no, this is not a left-wing or Keynesian casual attitude to debt. But there is one big proviso on the nature of this debt. It should only be debt to British citizens, resident in Britain, or their proxies, i.e. British jurisdiction-based pension companies. You see, if the government owes debt to its own citizens who work and live within the British economy, from the international point of view, there is no debt. British citizens, as represented by the government, owe money to British citizens as represented by pension funds or as represented by themselves. The government may have a debt, but the nation does not. This is a way in which sovereign economics is different to orthodox economics. It is very similar to the national economics of Friedrich List in its basic principles. Notably, we consider the national economy as a unit, and we look to the interests of our nation and its people. This is not about being selfish, it is just that you cannot manage the economy except as a national unit, neither practically nor conceptually. Ever since governments have gone into debt, they have often looked beyond their own shores to sell the debt, to sell the bonds. This practice is horribly disruptive for the currency and for international trade. The big advantage historically of borrowing abroad is that defaults are easy and usually go unpunished, but this is hardly a good reason for the British government to be selling its debt overseas today. To move to entirely British-owned debt, we should give foreigners 3 years' notice that they will have to get rid of their British bonds or they will forfeit them. The immediate result would be a fall in the value of these bonds, making them cheap for British pension funds to purchase. The yield would correspondingly go up, and so British pension funds investors would see a very marked improvement in their situation. They would be richer, and this in turn would be good for the domestic economy. The losers would be the foreigners holding the bonds, but in reality, the possibility of this policy coming would be flagged up for a long time before, enabling them to plan accordingly. Orthodox thinking would raise a well-rehearsed objection to this. No British government would ever be able to sell its bonds abroad again. And so the age-old mentality of getting hooked on debt to others rears its head. If we cannot borrow abroad again, so much the better. It is usually said that the government being in debt is a bad thing. After all, no one likes being in debt, and so as owner of our government, we don't want it to be in debt, do we? Well, yes, actually we do want our government to be in debt, as long as it is in debt to our own people. It is debt to foreigners that is the problem. If the debt is internal, then all that has happened is that those who have cash have moved this cash to those who have less, with a payment of interest naturally following. Anyone who has a private pension, which should be most people, lends money to the government. In fact, it should be the duty of government to provide a safe place for people to place their savings. I repeat, it should be a duty of government. So the government being in debt to its own people in a properly run progressive capitalist system is a good thing and a natural thing. Part 12. Savings equals investment fallacy. The last fact mentioned in the last section is seldom appreciated, for according to orthodox economics, the savings of normal citizens provides the source of investments for companies. You can read over and over in orthodox textbooks of any persuasion, Keynesian, Smithian, Austrian, etc., the fallacy that savings equals investments. This nonsense is, like so much orthodox economics, theoretically flawed and empirically disproved. In reality, investment for industry comes from 3 sources. Bank loans, which are created by the banks augmenting their balance sheets, and nothing to do with any savings. Government subsidies, and lastly, and least important, venture capitalists. This last group are gamers who can afford to lose the money they put up. That is to say, they are Dragon's Den types. The normal savers cannot accept risk with their capital and do not ever invest in industry developments or startups. They may hold shares, but that is not investment in the real sense. Unfortunately, the phrase to invest money is used for to place money, as if there were no difference. When you buy a bond, buy a share, buy a property, except in exceptional circumstances, your capital is reasonably safe. It may go up and down, but you will not get wiped out. If the economy was properly run, you would almost certainly gain, not lose. When a bank makes a loan, it may lose the whole lot, and it can take the loss thanks to the magic of fractional reserve. But let's not go into that. I cover that elsewhere. A venture capitalist, likewise, knows that they may lose everything. This distinction between investing and placing is essential, but orthodox economics runs them both together, and this allows them to adhere to the absurd fallacy that aggregate savings equal aggregate investment. Part 13. Sovereign money. So let's go back to the government. I envisage a government in debt to its own citizens and taxpayers, and that this is desirable and natural. But what happens if still the government does not have enough money to pay its way, financing all the public services, etc.? It cannot use the age-old solution of seeking foreign debt. So what does it do? Go to the central bank? Certainly not. The central bank is not there for substantial loans to the governments. It is not a commercial bank, and so does not make loans to anybody. It is just there to oil the works in a properly run economy. The solution to this situation for the government is in creating what I would call sovereign money. Sovereign money is created by the sovereign. In the old days, this meant created by the monarch. Today, it means created by a sovereign government, which we assume is democratic to a reasonable degree. To create sovereign money, the government has no recourse to any external body like the central bank. The government treasury simply adds the money to the asset side of its balance sheets and proceeds to spend it. No debt is created. The people will benefit from the spending. It seems like free money. Well, it is free in a way, but it is not as simple as that. If too much money is created, then asset prices will inflate with all the problems of inequality that induces, and so society will suffer. As I have been at pains to point out, the extra money will have no effect on consumer retail prices and may actually decrease them due to more competition and economies of scale. There are also consequences for the currency international exchange rate, which we will not go into here. How do we ensure that not too much sovereign money is created? We will need a government agency that will monitor just one indicator. The idea of independent committees or wise heads that are capable of taking a view on things, like the Monetary Policy Committee of today, cannot work. It will never be independent, and it stands very little chance of being wise. But monitoring just one indicator is feasible. This one indicator must be asset values. In a strong, healthy economy, there will inevitably be asset price rises, and this is only good and right. The problem is when those rises are due uniquely to an increase in money supply, as has been the case in Britain, the USA, and other places since the 1980s and before. This increase in money has come from private banks who have been deregulated, and so that needs to be sorted out to return the situation to sanity for any other reform to work. With that carried out, and I write elsewhere how it should be done, and if no or little sovereign money is being created, but asset prices still rise, you can be certain that the asset price rises are due to benign factors. In this way, you can monitor and adjust the amount of sovereign money created. On the other hand, if you increase sovereign money and there is no observable in asset prices, you know that the money was needed and it will do no harm. Part 14. Conclusions. The Western world, I make no comment here on Russia, China, Iran, etc., is financially currently in the most dangerous situation imaginable. That, together with all the other problems, geopolitical, health, etc., that we face, means all our futures are in a parlous state. QE, as the economic policy upon which monetary management is based, is at the root of our problems. Here I have tried to coolly set out some principles as to how money should be managed in a sane nation of the kind we wish to construct. To recap, these are the reforms we need. A. Restore the central bank to its role of oiling the works, neither taking nor implementing any policy decisions, so no QE of any kind. B. Repatriate the ownership of all government debt and sell no more government debt overseas. C. Create a limited amount of sovereign money in line with the economy's natural economic growth. D. Prevent the private banks from loaning on housing, returning that function to building societies alone, allowing the banks to concentrate on their core function of lending to industry for investment. There are many other economic reforms that I propose that, hand in hand with changes to monetary policy that I have described, would make Britain a leader in the world again. But nevertheless, the above proposals could be carried out in isolation to great benefit to the nation, and they would work.